Hi traders, in this video I'm going to show you how to find a solid trading edge and easily build a professional grade system for consistent profits. This compact guide will teach you 6 professional level edges and the type of strategy you could use with them. Let's get to it. Most traders lack a true edge and their trading strategies fail because they don't have an edge. What is edge, you might be asking? This video will show you what edge is and how to find powerful market edges that can transform your trading. An edge is a statistical advantage which basically means that no matter how long you trade for, as long as you remain consistent in implying your edge, you will make money. Either you have one or you don't. If you don't have one, you're not going to make money. If you do have one, you will make money in the long run. Why do I need edge? Market pricing originates from the emotional dynamics and intensity of the interaction of market players, meaning their attitudes, psychological state of mind, and underlying beliefs. These qualitative factors are difficult to quantify. This is certainly one reason why many trading systems are based on quantitative factors only, like indicators. But it's the integration of both quantitative and qualitative factors that result in long-term stability and profits. The 6 edges I will reveal shortly will make much more sense of this. Since all markets are subject to these dynamics, the same patterns can be found in different time frames like 15-minute, 1 hour, 4 hour or daily charts. Markets are fractal. Therefore a system with edge can work across assets and time frames. A trading system is based on certain beliefs about market behaviour. For example, believing trends persist or that statistically the crowd loses shapes your strategy. The goal is finding trading ideas with a low risk profile and high potential reward in profitable niches that are stable over time. These niches are your edges. In simple terms, that means that some traders build systems just on numbers, like indicator signals, and they work great in backtests but usually flop in the real markets. Why? Those are just patterns, not reasons. A professional system starts with beliefs about why markets move, like traders panicking in a trap. These whys are based on human behaviour, not just data. Okay, so here are 6 edges that professional traders use to win. They work with or without indicators. Market trends continue longer than market players might ever expect. Edge 1. Develop a trading system that trades with the trend, a trend following system. For example, moving averages or Williams alligator based. Price consolidations within a trend are times of refreshers or short pauses required for the trend to regain strength before it can continue. Edge 2. Look for entry opportunities in a trend after a consolidation has occurred. So using a strategy that focuses on entry from within a consolidation. This edge focuses on volatility contraction. The Bollinger Bands and Average True Range (ATR) indicators in this example are excellent for volatility-focused strategies. Periods of low volatility, defined by low values of the ATR, are often followed by large price moves. Other suitable volatility-focused indicators would include Keltner channels and Donchian channels. You can see in this example a squeeze of the Bollinger Bands, then a breakout of the upper Bollinger Band. The ATR is also showing high volatility. The crowd is usually wrong, causing it to lose money. Only a very few win. Edge 3. Take counterintuitive entries, like placing a limit order for a trade where you would have placed your stop loss. This edge does not follow the way the crowd sees things, but is rather counterintuitive and contrarian. Fibonacci strategies can be used to great effect for this type of entry. In this type of situation, you can draw Fibonacci levels from the swing low up or the swing high down in an uptrend to predict likely pullback levels. The super powerful 78.6 level gives perfect accuracy here for a high risk reward sell when most of the crowd has recently gone long. Price breakouts are popular with a large number of market participants. These are easy to spot and seem logical. Statistically speaking, most breakouts fail. Edge 4. Trading false breakouts. Identifying situations where breakouts are highly likely to fail. I will cover a superb failed breakout strategy in an upcoming video I'm working on. Many inexperienced traders trade against the trend, are emotional and lose most of the time. Trading in the direction of a trend often seems too boring and slow. Edge 5. Find those situations where counter-trend traders get their fingers burned and enter there with the trend, so become a counterparty to the counter-trend trader. This would use a pullback focus strategy. The strongest and most reliable momentum moves originate when market participants are caught off guard, the so-called traps. They then need to close out their position at a loss, driving the price still further offside. Edge 6. Find situations that cause great pain to as many market participants as possible. These are usually situations that look very safe and then turn into negative territory very quickly indeed. The trader trap. So for your entry, become an expert at spotting a trader trap. Then open a position when counter-trend traders are stopped out. Volume focused strategies and moving averages can be great here, as well as technical analysis skills. Trader traps usually come from a really obvious looking price move starting to play out before it completely reverses and causes deep pain for those who were suckered into trading it. Here's how to make your new trading system with Edge. Professional traders can write down their trade plan and articulate it without deviation. The reason for this is that an edge only works if it's applied consistently. Base your system on beliefs about market behaviour, like the 6 edges we've covered. As a basic example, you could say, I believe trends persist and false breakouts or breakdowns offer good trading opportunities. Then define your setup. An example could be a trend following system entering on a false breakout after consolidation, confirmed by chart patterns like hammer or shooting star candles, price action, higher highs or lower lows, and MACD crossover. Then add filters to eliminate losing trades, like avoiding setups during high impact news or low volume hours. A well-defined entry and exit signal. These are important for an edge because they allow consistent application. Consistently applying your strategy and edge is vital to becoming a profitable long-term trader. An example could be a MACD crossover on a specific time frame. Predetermined long or short bias. This is important not for consistent application, but to ensure you have a higher probability of the market going in your direction. There's no point in having an edge with a positive risk-reward expectancy if 95% of your trades are failures. Risk-reward ratio. Conversely to the last rule, there is no point being correct 95% of the time if that 5% of the time you lose, you wipe out all of your profits and then some. Your exit strategy manages 3 phases: capital preservation with a tight stop, profit maximisation at break-even, and profit preservation and growth potential with trailing stops. Make sure position sizing aligns with your goals. Risking 1 to 2% per trade is a common example. Down the line, you can dynamically adjust sizing. Use profits to increase risk later on as your account grows, a concept called markets money. A positive risk-reward ratio can be a significant trading edge. A positive risk-reward ratio means that the potential profit from a trade outweighs the potential loss. With a suitable win rate, using other edge, this can be a very powerful addition to your system. Money management. Money management is critical as an edge has to be allowed to play out over time. Even if you have an edge which will make you money every 100 trades, if you have poor money management, you will lose your account before your edge even gets a chance to work. Expected value or expectancy is the amount a trader should expect to gain if they were able to place infinite similar bets. EV, for short, is technically defined as the sum of all possible outcomes multiplied by the probability of each outcome's occurrence. EV can be used as the most rudimentary form of trading edge. Consistent application. This is so important that the first 3 principles are all designed to help implement the last principle. Without consistent application, an edge really isn't an edge at all. Professional traders journal their trades and measure and analyse their performance over time. The System Quality Number, SQN, measures performance, balancing profit rate, expectancy, volatility, and yearly trade frequency. A high SQN indicates a smooth, profitable system. Pros backtest for expectancy, forward test to refine, and simulate risk multiples R for statistical confidence. So in this video I've revealed 6 professional level trading edges that you can study and integrate into your trading. I hope you found this helpful, and all I ask for in return is a very small favour of liking the video and subscribing to the channel. It literally takes only 2 clicks and it means a lot to me. In return, you'll get notified when I post more high quality trading videos like this one. Thank you for watching, and I'll see you in the next video. Keep chasing the edge.